Welcome to this short and crisp webinar. You are going to get crystal clear clarity in this very short duration, and that's my assurance. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career in banking industry through State Bank of India, joined as credit analyst, in short period elevated as team leader, credit processing, had opportunity to work on 250 plus projects, it's 5,000 crore plus size. After 4 years of stint in State Bank of India, I moved to CA practice, had my practice for 7.5 years, parallelly took teaching assignments, started teaching financial management, strategic financial management for CA, CMA and CA students. I'm also an empanel trainer with leading private sector bank for training their executives on financial analysis, working capital and project finance. Thanks to technology, today I teach 2 lakh plus students all over the world through my structured online courses, and it's because of the same technology you are also attending this mini webinar now. One more thing, if you don't have your notepad and pen, please pause the screen, go and take notepad and pen because you are going to have many key points to make note of in this session. Let's get into the presentation.
In this session, let us understand what is net present value technique. This is one of the major tool which is used for understanding viability of the project and one of the major tool in discounting category, because we know capital budgeting tools can be divided into 2, traditional and discounting based, and in that the major tool is NPV. Now, how NPV tool is going to help us in selecting a best project? So what we do in NPV, basically we have a formula. NPV is equal to PV of inflows minus PV of outflows. Present value of inflows minus present value of outflows. So what we do, we will find out all the inflows and we will find out the present value by discounting the cash flows at cost of capital. So we take cost of capital. That cost of capital will be used for finding the discounting factor. Then those discounting factor will be multiplied with cash flows, and that will help us to find out the present value of inflows. Now that present value of inflows will be compared with present value of outflows. Let's say my PV of inflows is something like 120 million. And my PV of outflows are 100 million. So what is happening? What I've invested in the project is 100 million, which happened now, whereas the present value of inflows, this can be maybe related to the future years but brought to the present value. Let's say it is 5 years cash flows but brought to present by discounting, and it is 120 million. So what is happening here? I am getting a net benefit of 20 million. It means I made an investment of 100 million now, and I brought all the future cash flows discounted to the present value language, and it is as good as getting 120 million now. Okay, so understand, I have invested 100 million now and it is as good as getting 120 million now, which is over and above my invested amount. And what is the net benefit? I'm getting 20 million. So this is the wealth which is added to the shareholders immediately. Okay, so in that angle, this is good for the organization, because the way in which I found the present value is by discounting, and the discounting will take care of my expected rate of return. Expected rate of return is nothing but the cost of capital. So since I have discounted it at expected rate of return, and despite discounting, the present value is greater than the investment, okay, which is 120. So I have a surplus. So this is called as positive NPV. Here NPV is positive. It means it is as good as giving 100 now and receiving 120, making an immediate wealth of 20 million for the shareholders. But just imagine another scenario where my PV of inflows are going to be 80 million, okay, whereas my PV of outflows, the investment which I am making in the project is something like let's say 95 million. So how much I have invested in the project? 95. How much I am going to get? It is 80. So what is the amount I am losing in the project? Which is 15 million. So here the amount is negative. It indicates it is as good as giving 95 million now and receiving 80 million immediately. So in the process, I am losing 15 million. So that's what your NPV will communicate. Here the positive NPV says you are making an immediate wealth. That is, it is as good as making immediate wealth of 20 million to the shareholders, and this is as good as losing 50 million immediately. Now it makes more sense because this project, if you look at the cash flows, here the present value is 80 million. But instead of looking at the present value, if I am going to look at the gross cash flows, it will be greater than 95 million, and many of the investors will get carried away by that number. But when you bring it to the present value, you realize it is not even 95 and you are actually losing. And in this project, the present values will be obviously greater than 100, but it is going to tell you the real face of it. It may be 200, it may be 300, but when you bring it to the present value, you are getting what is the clear picture of it, which is only 120 million. So understand the net present value technique. The formula wise, it is very simple: PV of inflows minus outflows. If it is positive, it means that project is creating wealth to the shareholders and it is at present value language. And if it is negative, it means the shareholders' money or stakeholders' money is getting lost in the project. So how decisions are taken? By looking at NPV. If NPV is positive, okay, then we can select the project. Why we can select the project? Because positive means the project is earning. Okay, positive means the project earns, or say the project earnings are greater than expectations. So that is the point. If NPV is positive, it means project earnings are greater than expectations. If NPV is negative, then we have to reject the project because project earnings are less than expectation. So what do we do if NPV is equal to 0? If it is positive, we will select. If it is negative, we will reject. What we will do if it is 0? It is a scenario where the project is earning exactly equal to your expectation. Okay, so you can very well select, or if you have choice of projects in front of you, and if there are some other projects which is giving you positive NPV and this project is giving 0 NPV, then you can go ahead with positive NPV projects. But let's say you have only project in question in front of you and that has NPV as 0, you can very well select because that project is earning exactly what you have expected. So here it can be either select or reject depending upon the choices. So if you have only one project and their NPV is going to be 0, you can go ahead with that. But you have several projects and some of the other projects are giving positive NPV and this project is giving 0 NPV, then you can reject it because the other projects will add more wealth to the shareholders. So here the understanding is project earnings is exactly equal to expectations. Okay, so this is about NPV.
Thank you so much. We have come to the end of this mini webinar and I am sure you would have derived much value from this short and crisp webinar. In my opinion, what you have seen is only the tip of the iceberg. There are several other interconnected topics which you have to learn in order to achieve excellence and mastery. So if you wish to continue this learning journey in a more organized and structured way, I have an amazing opportunity for you. I have published a series of comprehensive courses in financial domain, each costing rupees 2000, but I'm going to give it to you at a special offer price today. Here we go, Finance and Accounting Mastery Bundle. In this bundle, I'm going to give you a series of courses. To start with, we have Financial Management, a complete study. In this course, you will be learning financial management in depth. Topics like basics of financial management, time value of money, financial analysis like ratios, cash flows, fund flows, cost of capital, capital structuring, capital budgeting, NPV, IRR, everything discussed in depth in this course. Then we have course number 2. Advanced Financial Management. It's a comprehensive course and you will learn various advanced concepts like advanced capital budgeting techniques, risk analysis, sensitivity, derivatives, leasing, forex management, portfolio management, dividend decision, mergers, acquisition, several miscellaneous topics and securitization, security analysis, valuation. Next we have course number 3. Accounting Basics, a complete study. This course will give you solid foundation in basics of accounting. You will learn basics of accounting, technical terms in accounting, double entry system, journalizing process, final accounts, everything in depth, a comprehensive ever course. Then we have course number 4. Advanced Accounting, a complete study. In this course, various advanced topics in accounting are discussed and covered. Just have a look at the screen for the topics, exhaustive topics that are covered in this course. Then we have course number 5, that is Cost Accounting, a complete study. In this course, you will learn various topics related to cost accounting. You have topics starting from basics of costing till ABC costing. So overall, 5 courses, each course priced 1,999. The overall value is close to 10,000 rupees. It's 500 plus lectures, and what you get is lifetime access to all these pre-recorded courses. You can access them in mobile app and desktop. All this is going to cost you close to 10,000, but today you can enroll for just 2,499. It's not yet over. I'm going to give you something more. You are also going to get access to various bonus resources, basically ebooks. So it is overall value close to 10,000 rupees, 15 ebooks of value close to 1,500. You are going to get lifetime access to all these courses and e-resources.